Bienvenue and welcome to Chapter 4. I'm thrilled that you joined us looking at this core chapter, not only of microeconomics, but the economy as a whole. Markets, how do markets work, and how do we model them, which will also bring a bit of math or mathematical modeling into it. Basically, this is a shorter chapter because it focuses on bringing together the things that we learned in chapters 2 and 3, demand and supply. And you might recall that there we said it's about the plans of producers and consumers. What do they want at different prices? What do they want to buy? What do they want to sell at different prices? You see that this time it's only one part, one video about chapter 4, where we bring together these 4 different parts, and sort of the core is bringing demand and supply together. In fact, we are going to start then with the disequilibrium part, bringing demand and supply together and asking ourselves, okay, what happens if we are not in the equilibrium? And then what does the equilibrium sort of bring to our analysis? And from there on, changes in demand and supply, price floors and price ceilings. We're going to talk about the economic theory, the concept of market equilibrium. The equilibrium, I'm sure you heard about this, the point where supply and demand meet and where at the end consumers as well as producers fulfill their plan and can be content, and where the best outcome results in this market equilibrium. But we start with the situation where there's not an equilibrium that we call disequilibria, where there's either more supply than demand or the other way around, and then come to, okay, how do we achieve this equilibrium? Once we talked about it, what happens if there are changes to demand and supply? These are sort of the most important topics. A brief excursion, we could say, into price elasticity. And our book talks about pooling and separative equilibria. We are not going to focus on this strongly. Business problem, picking a winner, who gains most of it. For example, which supplier is the one that achieves at the end that we go there and we buy, or which suppliers. In equilibrium it might be many or all of them. What will be the marketplace in the future? How can firms foresee this? How will sales change, and so on? These are possible questions that occur as business problems. So now back to our willingness to demand at particular prices, the demand curve does this. We analyzed that. You might recall that we talked about the consumer surplus when this willingness is higher, for example, than the price you really have to pay. And the supply curve is the other way around, the firm's willingness to supply at particular prices. And let us bring these two together, these plans of consumers and producers. As I said, there is a bit of theory, but before we go there, you can see this here, you can find this in the book, that if we bring our 2 equations together, quantity demanded, A plus B times price, and our book here says A demand plus B demand times price, and we know plus is the mathematically correct way, but it will be negative at the end. The same for supply. How do we bring these 2 together, and what is the resulting price? But we don't have to do this purely theoretically, but let's look at the graph where the market equilibrium occurs, and this is figure 4.1, but I'd like us to go back to our good old Apple example. As we said, when we talk about market, we can imagine whatever different things. The typical market that we encounter is the supermarket, perhaps also online markets, little shops in our neighborhood, but also farmers markets exist, and from time to time we see them. I personally have the privilege that I can go to work by bicycle in Bremen, and I pass through the Domshof every morning, and the farmers market is there every morning. So when I want to keep my stocks of apples in my office on a good size, and to be honest, I always have at least 2-3 apples there in order to have something when I work late. So in the morning when I pass through Domshof, I will think about how many apples do I have and do I want to buy some apples? So I look at the prices there. My demand curve is a downward sloping demand curve as the demand curves of all the others. And as for different prices, I have different demands. If the price is €5, I definitely not going to buy any apples. At a price of €4, I still would say that it's too expensive, but I don't have any apples, so let me get one or something. If the price is 3, 2, whatever, I might take more to have a bigger stock in the office or even take some home for an apple pie. The farmers themselves, or the sellers, have a different rationale. They would like to have the price as high as possible, and the higher the price, the more they are willing to sell. So that's our upward sloping supply curve that we just added here. But let's say before we come to this equilibrium, which is obviously the point where the two intersect, before we come to the equilibrium, I said I have the privilege to pass through Domshof every morning, but that's relatively late. That might be 8:15, or if I have classes at 10, that might be 9:30 or something like this. The suppliers are there quite some time. I don't know when they come, but it might be between 5 and 6 or so. So first of all, they can talk to each other and say, the last days the apple price was really low. It was something like $2.50. It's just not hardly worth it to bring the apples to the market and so on. What do you think? Shouldn't we just take $3.50 today? And so they all put up their little signs and say, apples $3.50. So what happens in this situation? If the price is $3.50, we observe different values, different willingnesses of suppliers and demanders. We can see that the suppliers are really willing to say quite a lot, to sell quite a lot. That's this. So 700 boxes of apples they would like to sell. But as many consumers like me would pass and would say $3.50, that's really expensive. I might say, okay, I get one because I know I don't have any in the office, but I'm definitely not going to buy more, or I'm not going to get any stock and so on. So we have a difference between the quantity supplied and the quantity demanded. And the quantity supplied is bigger than the quantity demanded. We call this a surplus. Not to be confused with the consumer surplus we talked about in chapter 2, but it's just here surplus. It means more supplied than demanded. So what is going to happen if you observe the things that happen on markets? The market closes at 2 or at 3, whatever. And let's say at 12 o'clock, 12:30, the farmers still see, I have most of my apples still here because people don't buy it at that price. Oh, I'm afraid we have to go down with the prices, and we have to say, let's say we take €2, it might be better, in order that we don't have to bring so many apples home. They don't get better if we carry them back and forth. So, okay, 2. If there's a surplus, the typical reaction is that prices go down. And as we observe, obviously the price decrease was too big because we end in the opposite situations. We're no longer in a surplus where quantity supplied is bigger than quantity demanded, but we end in what we call a shortage. Shortage as quantity demanded is bigger than quantity supplied. Might be not that easy to read, but you can see it directly. And you might guess how the story goes on in a situation of a shortage. farmers see, okay, there are many people, they want to buy our apples, because everyone, not only Peter, but everyone has the idea, oh, apples are so cheap, cheaper than at other places and cheaper than at other days. So I get 2 kilos and make an apple pie or make some cake and so on. Many people wanting to buy, but might even be that they don't have so many apples, or the other way around, they even don't want to sell so many apples. Here, in this case, the consumers would like to have 550, but at the end, the farmers are only going to supply 450. That's what makes sort of the shortage. There are not that many apples in supply as the people would like to have. And you might guess the result is that prices go up if there is a shortage. And so this process of trial and error, price a bit higher, price a bit lower, and so on, is the typical process that we observe on markets, even if we sort of observe on our own. And you can often see on these markets that prices are changed, and then you have no longer 350 here, but the prices are changed, and let's say, for example, 249 as a starting point. And as a result, you see our equilibrium price at 249. In this equilibrium, quantity supplied is equaling quantity demanded. The plans of the consumers and the plans of the suppliers are the same. From an economic point of view, a general economic point of view, or let's say our welfare, everybody should be as well off as possible, which we defined in one possibility, in our allocation target, as many as possible of the desired goods should be traded, or should be there, and in this case, traded. If we compare the three situations, we see that this is the case. Because when we go to the first situation of a surplus, then at the end, it would have been 350 traded. Although the suppliers wanted to sell 700, but if people don't buy 700, but they only buy 350, that doesn't work. The same situation in the shortage case. In a shortage, the firms were willing to supply 450 and the consumers were willing to buy 550. But they never get these 550 as long as the firms only sell 450. So we see that the equilibrium price, PE as we denoted it here, leads to the highest possible quantity traded on the market. Which is the core reason why the equilibrium is in the center of economic analyses, why we would like to achieve this equilibrium in order to get the best result for everyone, which is the equilibrium situation. So we learned that this equilibrium is unique. There's only one equilibrium. We learned that it leads to the highest possible quantity on the market, and that it's a trial and error process, and that the equilibrium price doesn't have to be there at the beginning, and that typically happens if a company introduces a new product on the market. It often might be that the price is too high, people don't buy, or that the price is too low and everything is sold out. These are things that we observe on a daily basis if we look around on the market. And so the firms, you might recall this, picking a winner, the firm that can predict the correct price and the correct reaction of the demanders, wins the day and has the best possible outcome here. We already saw this in figure 4.1, where we have the situation described and where at the end here we get an equilibrium price of 10 and an equilibrium quantity of 100. Comments on the equilibrium. The equilibrium is unique. This is what we just described. Prices where demand does not equal supply are known as disequilibria. And there is something that says market forces should push markets from disequilibria to equilibria. And that's exactly what we described. If there is a disequilibrium, people are not satisfied, and typically the firms that cannot They cannot set prices, but they can offer prices and then try what is the reaction of the consumers. And firms are going to try to do this. Perhaps one more remark here, the equilibrium price. What we do here, what we observe is price determination. So now with analyzing both sides, demand and supply, we get something, or we get an explanation why our axes are so strange, or used to be so strange, because we had the dependent variable on the horizontal axis. Now, when we talk about price determination, we see that at the end, now it's the price that is determined by the forces of supply and demand. In a simultaneous way, the quantity supplied and the quantity demanded, they both react on prices, but the prices are set in the simultaneous process of supply and demand. Let's keep this in mind. That is a reason that we sort of could now write here price of quantity as a function of quantity, as price is determined by quantity, whereas quantity supplied and quantity demanded are determined by the price themselves. Our next part, 4.3, talks about changes. Changes, we could say, or we have to say here, of exogenous factors, of the exogenous determinants of supply or demand. And I made just 3 bullet points here and on the other side as well for supply. So that means please review or recall. Perhaps you just know and you say, oh, it's clear. The external or exogenous influencing factors of demand were this and that, and we can now focus on what's happening. So let's say there is something happening, and I write down one of them, that might be the income. And let's say in this situation, the income goes up. There is a change in income, there is a new government and a rise in BAföG or whatever, the economy behaves well and develops in a good way. We all have more income. What is the typical consequence? Typical consequence is that the demand increases. Here we see an example, or here we see the difference between the demand and the quantity demanded. For the price, for the equilibrium price of 249, the quantity demanded then is no longer 500, but it's far higher. And you can see, if we compare the situation to what we have been discussing up there, the disequilibria, now at this price of 249, the demand is higher than the supply, which leads, at least temporarily, to a shortage. There's more demand than supply. But as we heard, in a shortage, typically the price goes up and the whole trial and error process starts again until we arrive at the new equilibrium. And we can also see that the resulting equilibrium here, it might be at 700, at a price of 350, is not a pure result of only one thing. It's not only the demand shifting to the right and then the quantity goes up to 900. That doesn't work, as there is the market reaction that we described, and we go to the final equilibrium. So this here, this shortage is only a temporary thing until the markets react and until the markets find the new equilibrium. And as I said, there are different reasons here, different exogenous factors, and that's the homework, to think about this and to think about what happens, what might be the influencing factors and what happens there. This reaction might, of course, go in both directions. You can see here in figure 4.4, right shift in demand. You can see in the next figure 4.5, a left shift in demand. And in case of a left shift, both go down. The price goes down and the quantity demanded goes down. If we look at supply here in the next figure, you see that if an exogenous variable determining supply changes in that way that supply shifts to the left, we see that there's a difference. The price goes up, but the quantity goes down, so the two go in a different direction. And also here we can see that there are different factors, and let us discuss in class which factors bring the supply curve to shift to the left or to the right. So we have these two reactions, and of course here also this can go in both directions. That figure shows a shift to the left, but there can also be a shift to the right. We said in the table of contents that the elasticity also plays a role with equilibrium changes. Have a look at figure 4.8. Also this we are going to discuss in class. What is the difference? What are the different influencing factors here? But I don't want to draw this. You have the different figures, 4.9 and 4.8, and you can discuss, so you can see what are the effects. And most importantly, also, what can we learn? We as firms, or you as managers in firms, what can we learn, again, from the different elasticities and reactions in order to follow our goals as firms? Part 4.4, shortages and surpluses, we already discussed at the beginning. So there's 4.5, price floors and price ceilings, or as a headline, fixed prices. What happens if prices are fixed? So we don't leave price determination to the market, but there is an authority saying the price has to be either exactly this, or more common in reality is our price floors or price ceilings. Another name is minimum price and maximum price. And typically it's a government, a regulation that says the price must not be lower than this, the price must not be higher than this. Let's take the minimum price or price ceiling as an example. The market price is 249 in our left-hand example that we see here. And let's say the government says, no, that's not enough. The minimum price that can be charged is 350. We do not allow prices to be lower than this. Price must not be lower. It's forbidden that the price is lower than 350. We call this a minimum price or a price floor. And also this, a classroom application. Let's look together at this. What happens in this situation? It's a situation that we know. We only have to take a look at the left for the disequilibrium analysis. But anyhow, this we can say, okay, this is what results. And then the next question is, does it make sense? Do we know examples from the real world? Do we know examples where governments or other institutions say the price must not be lower than? And do you think this is appropriate? That's something that we are going to discuss in class. You see here the class applications. Find examples for fixed prices, in this case the minimum price or price floor, or on the right-hand side the maximum price or price ceiling. So much already for chapter 4, and we have some things to do together, to discuss together, which means that you are kindly invited or requested to prepare to think about these questions so that in class we are able to answer them and to discuss what we find here. You see the second question, do you find these interventions appropriate? What would be alternatives? And that's the first time where we sort of apply the questions that we raised at the beginning. Should the government intervene into markets? And if so, which possibilities does it have? We apply it sort of for the first time in this theory here. That's the one application. The other application is, you might recall this wonderful slide. In part 4.2, we heard about simultaneous equations, the simultaneous equilibrium that we find at the end. And as I said, from my point of view, you don't necessarily have to recall this A, D, B, D, and so on, but do it with numbers. But that's something that you should really be aware how to do this, as this is, of course, something that I'm also going to ask you about. So let us, at the end, take just one example and then compute the equilibrium. So this last frame contains the task that I recommend that you do before class, so that we can talk about, is it easy to do, is it straightforward, or are there questions, are there things that are not clear? These are the tasks to be done in class. Looking forward to doing this to you. See you there.